Bloomberg Audio Studios.
Podcasts, radio, news.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Nordstrom family, they're going to acquire all the outstanding common stock not already owned by them. And here with more is Bloomberg's Emily Cohn. Emily, thank you so much for joining us here in studio. Nordstrom, why are they going private?
So we have Nordstrom here, a retail giant that's really been struggling. It's been struggling to compete with fast fashion. It's been struggling to compete with discount chains like TJ Maxx. So we have the company saying that they think they can do a better job navigating this tough retail landscape, taking the company private without the scrutiny from Wall Street, so they can really focus on their operations.
What does that look like, Emily? Does that mean cost cuts? Does that mean job cuts? Does that mean a tougher period to come if you're part of Nordstrom?
I think that's still to come. I think we don't know, but I think probably all of those things are on the table. This company has, it was once worth $15 billion, I believe, in 2019. Now it's going for $6.25 billion. The stock price has plunged 40% in the last 5 years. So there's a lot that needs to change.
Emily, there's a lot of Nordstroms in this management team, in this ownership. How does the street view this family ownership in terms of being managers?
That's a good question. I think there's a lot there. I think the company has invested a lot in its rack business. That's the discount chain that's competing with TJ Maxx. I think they've seen a lot of growth from Maxx in recent years. I think you might be seeing more investment in that. That's definitely been a better than expected part of the business. That's the part that competes with the TJ Maxx, and you get stuff that is very discounted, and that's sort of like what consumers these days are looking for when they're shopping.
They sure are. Let's just talk a little bit about a Mexican involvement, because 50.1% is going to be held by the Nordstrom family. But then a Mexican department store owner is coming in and taking up the rest. Is that about agility? Is that about finding strategic investors here who know how to operate?
Yeah, I think it's also about the cash, and this is a big department store chain in Mexico, and they're helping finance the deal. Okay, money on the table always helps, as does a little bit of operational flexibility, I'm sure. Great to have time with you. Thank you so much, Emily Cohn, all over this story. Big $6.25 billion deal for Nordstrom. Let's just broaden this out, Paul. Let's talk about the retail industry going into 2025 when we get those pretty ugly consumer numbers in terms of confidence today. And we're pleased to welcome Jennifer Bartashus. She can do that with us, of course. She is of Bloomberg Intelligence. And Jennifer, push us forward as to what we're looking like from, we've got a Nordstrom signaling that they want to go private. They need to rework and re-energize their business. How is the rest of the high street set up for 2025?
Good morning. So one of the things that we're looking at is really the consumer is doing well, but it's about where is their focus, and the focus is on value. And so what we're seeing is across the entire industry, a lot of retailers trying to reorient their operations in a way that presents value, however that might mean to their core consumer. So for Nordstrom, you may see that pivoting in terms of the way they do their assortment, but for retailers like Walmart and Target, it's about price and it's about selection.
And there's a great story on that, Jen, on the Bloomberg terminal today. Leslie Patton and Jaewon Kang have this story. The headline's just a great headline. Kirkland for Christmas. Shoppers ditch logos for store brands. That kind of goes to your value argument. How do you see that with the stores you cover?
Yeah, value is as I said, it's of utmost importance, but private label had a great year in 2024, and we actually see that momentum just continuing in 2025. So Kirkland is Costco's own brand. It is over 30%, almost 35% of their sales, and it is just a trusted brand to the point where consumers no longer think of it as a private label alternative to national brands. They just see it as a brand in and of itself. Walmart, Target, Kroger, Albertsons, these companies have all invested in private label in the last last several years, and it's really starting to pay dividends because it's value, it's novelty, and it's something that consumers are really resonating with.
to get that data, to understand that it's resonating with the consumer, they're having to be leaning into all the data points largely through digital investment, I'm sure, and through artificial intelligence. How is that something that they're not just plowing money in, but getting the rewards back?
Yeah, the rise of retail media is really the answer to that question. And when we look at the industry, actually last year, we made a prediction that retail media would be up by over 20%, the revenue associated with it for 2024. And it looks like we're going to exceed that. And it's on pace to continue that kind of momentum into 2025. So retail media is really advertising. And it's the selling of ad space. It's the selling of search results. And it's on digital products, such as you see online, as well as digital screens that you see in stores. And so retailers have really been unlocking the value of that and are finding that it's a way to bring a high margin, very low overhead business into their mainstream core.
You know, Jen, that's a business, for better or worse, I have experience with. Back in my banking days, we tried to finance a bunch of those companies because we felt like, just like you said, they're captured customers. They're at the point of buying. What a great time for video to be introduced there in terms of advertising. What does it mean for the big retailers? What are the economics to the big retailers for this media?
So this media carries a margin of 80%, and when you think about retail staples, you're talking about operating margins in the 3 to 5% range, right? You're talking about gross margins in the high teens, low 20s. So the ability to have a revenue stream with such a high margin is very appealing to these companies, and they have the data. They have all this first-party data that they can monetize, and so it really is a very effective partnering. And one of the interesting things that we're finding is that there's always been historically investment from, say, packaged food companies into retailers for placement on shelves and things like that. But we're finding that retail media is actually incremental spend. So that's actually an even bigger tailwind for these retailers as they get deeper into this new revenue stream.
In many ways, everyone takes a leaf out of Amazon's book in the end. I'm interested, Jen, a little bit more about the pure data side of it and the forecasting side of it. We go to you to help us forecast what the retail looks like. How are the companies themselves forecasting in 2025?
Well, it's been interesting because what we've really seen were in 2023 and 2024, we saw some initial pilot cases of the use of AI, for example, to help with demand forecasting. And we're seeing that those pilot programs have been successful and are being more widely rolled out across organizations at places like Kroger and Walmart and Target. And what that really means is that they're getting more efficient and smarter about understanding when they need product and where they need product. That then goes all the way back up the supply chain and makes them more efficient as an organization. And so, that kind of cost-cutting initiative is good from an operational perspective, but it's also good for customers because that means that what they want will be in the stores or online available at the time they want it.
And Jen, what I learned from you a while back, which shocked me, still shocks me, who's the number one supermarket in the United States?
That would be Walmart. Over 50% of Walmart's sales come from groceries. And they hold a little over 30% of total market share in the United States, which is pretty significant.
And yet the regulators won't let Albertsons and Kroger get together.
It's the end of a 2-year saga. When we first heard the announcement of that merger, we thought it was actually good for both organizations. But in this instance, the FTC prevailed. The merger is now dead. And Kroger and Albertsons will just have to, continue on their own individual strategies, and we'll see how that unfolds.
Jennifer Bartashus, great to check in with you. All an important look ahead to 2025 retail and a bit of a look behind us at that M&A deal that went very sour. Thank you so much to Bloomberg Intelligence.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Julia Coronado's with us, Macropolicy Perspectives, president. And of course, you're the founder too. You once upon a time were a key researcher over at the Fed. So point us into 2025 and the clarity we need, because Friday, a bit of a relief in terms of the inflationary signals that we got. But certainly we'd all been rocked by what the Fed had been telling us earlier.
Yeah, that's right. Their messaging that we got at the December meeting was a lot sterner than expected, with only 2 cuts and just a general tone of concern about inflation. And I think, when we look at the data that's come in, it's fair for President Daley to say that, it's the data have been disappointing on the inflation front. But this wouldn't have really happened if it weren't for the risks to inflation in the outlook. And they can't really pinpoint them or put too fine a point on what's likely to happen. But every major policy prong of the incoming Trump administration could potentially be inflationary. So you can see they released their assessment of risks to inflation and unemployment, and the change in upside risks to inflation really moved at the December meeting. So we don't know the specifics on policy. Yes, we have to wait and see what materializes and how that feeds into the data. But there's a direction of travel here that's of concern to the FOMC broadly speaking. This was a big move across a lot of participants. And so, they want us to be on watch for that.
Have you been running the numbers, and with a best case, worst case scenario? Yes, we don't know the direction exactly of where policy will go, but we've been on this rodeo before, and there's been tough talk about tariffs in the past.
Yes, and we got tariffs in the past, and we did see them flow through into goods prices. The difference was that we were in an environment in the first Trump administration where inflation was running low and in fact below the Fed's target. So they could be very sanguine and patient and sort of accommodate the increase in goods prices that came with the trade war. This time around, we're in a different environment. They've just reestablished credibility. They've just brought inflation back down, not even to their target yet. And so, the threat of a round of tariffs and an impulse into goods prices is more meaningful. Now, the thing that they're going to have to grapple with, and we saw that also in last trade war, is trade wars also destroy demand. That spike in prices isn't good for consumer purchasing power, and it's unlikely to be accommodated like it was during the pandemic with a lot of fiscal support to households, directly to households, which helped the economy weather the inflationary shock during the pandemic and sort of stay on track. In the first Trump administration, we actually saw the trade war dampen economic activity, put the global manufacturing sector into a recession, and the Fed actually ended up cutting rates in 2019 to take out some insurance against that manufacturing recession broadening into the service sector. So, very different circumstances. This could weaken the economy. It could cause inflation. It could do both. And then the Fed's mandates go in different directions, and they have to make a judgment call.
Julia, so, tariffs are clearly an issue. What I've heard from a lot of folks is restrictive immigration policies, perhaps forced deportations. That impact on the labor market, that might even be even more inflationary going forward. How do you view that risk?
Yeah, no, absolutely. And I think that is definitely something we are likely to see. That is one of the main promises of the campaign, and we can already see the appointees and the plans being put in place to implement this policy. And let's not forget that immigration, that plentiful flow of immigration, while it became a political hot potato during the election, it's unambiguously positive from a macroeconomic standpoint. We had abundant labor supply. It helped growth, it helped demand. So immigration is good for the economy, and to even just turn off the spigot, let alone turn around and, cast a shadow over the labor market and deport some workers, it's going to change the macro environment. And yes, in areas where the most targeted population, the undocumented workers, are employed, food services, construction. I have conversations with people here in Texas, people in the real estate industry that are pretty worried about the availability of workers as early as next year, as early as the spring building season. So this could be very material. It could bring higher prices. It could also just slow down building activity because you just don't have the people that you need. Similarly for food, availability of certain crops and the prices of those would likely spike. So leisure and hospitality, another industry that relies heavily on an immigrant workforce. So yeah, we could see that ripple across numerous sectors in the economy, and it could be, by mid-year, we're seeing some material constraints and some price increases on the back of that.
And Julia, it kind of goes to that consumer confidence number we got today. Came in, weaker than expected, and the expectations looking forward were weaker than expected. That actually surprised me because I've been talking to a lot of our guests since the election about a palpable sense of optimism in this country since the election, particularly as it relates to economic outlook, reduced taxes, and so on and so forth. How do you think about the consumer and consumer confidence? Did that data surprise you today?
So I was just digging through those details. And of course, the optimism depends on who you ask. So you're probably talking to a lot of market participants who have experienced the rally and are looking forward to maybe reduced regulation in the finance industry, maybe some corporate tax cuts. But when you look at consumers, well, there's a lot of uncertainty as to how this mix of tariffs and immigration is going to affect more the average consumer. And when I looked at actually what was interesting, you could see a little bit of a political footprint here when you look at it by region. The Conference Board doesn't have the breakdown by political party like the Michigan sentiment measure does, but you can clearly see sort of the South confidence going up, but in the West and the Northeast, the confidence going down. So, we are a 50-50 country. We always have been. Some people are feeling better. Some people are feeling a lot worse. And it really depends on who you ask.
What about stockholders? Because, boy, 2024 should have been the year that made everyone feel pretty good. It's if you've been long AI, if you've been long S&P, NASDAQ, bigger benchmarks. And then it just tails off in the last couple of weeks. So how did sentiment around being an asset holder right now feel?
Yeah. Well, that's what was interesting about the numbers, right? It was the expectations component, not the present situation. We have been on quite a tear in the stock market. And of course, you all know that it's been very, very concentrated in a handful of names that are related to the AI, sort of euphoria. But now we're moving into the expectations meets reality phase of a change in administration. So by the end of January, we're going to know a lot more about this mix of policies. And some are growth positive. And some are growth negative. And so different industries are going to experience that differently. The tax cuts, I think one of the things that we just saw with the budget dogfight is that it's a lot easier to talk about tax cuts on a campaign trail than implement them in a very closely divided Congress. And even within the Republican Party, while they hold majorities in both houses, there's a lot of different views on the correct direction of fiscal policy. So we sort of imagine it's going to take most of the year to legislate anything meaningful on the fiscal front. They want to push forward a border package early. We'll see how that plays out. I assume they're going to be able to get a lot done. But remember, again, very different from last time. Budget-wise, the U.S. fiscal position is a lot worse than last time. And so that room for maneuvering is a little tighter, and their ability to enact something that's really going to change the backdrop is more limited.
Hey, Joy, about a minute left. How do you put in Elon Musk into your calculus here?
Elon Musk is going to be a noise generator at a minimum, and certainly will be, as we saw with this budget fight, fighting for things that are good for his companies. But I think what we also saw in the last week is that he's not going to just get his way. He's going to talk a lot. Do I think he's actually going to be successful eliminating the VA health care system? No, I do not. So, he's going to run into constraints. He's not an elected official. He actually doesn't have any sort of direct lever that he can pull. And these elected officials have a lot of views about the programs that they want to protect. And their constituents that they want to serve. So I think it's going to be messy and loud and harder to extract the signal from the noise.
Currently, his eyes are on the Fed. absurdly overstaffed. This is current take.
Absurdly overstaffed.
We'll
I looked at this number. The Federal Reserve entire system employs 0.012% of the 0.12% of the workforce. That's tiny. What do we get for that? We get oversight of the banking system, monetary policy.
We need to leave it there. But thank you for weighing in. Good context. It's everything here. That's Julia Coronado. This is Bloomberg.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Let's turn our attention, though, to autos now, because there is a big deal now being confirmed over in Japan, Paul. And it's not coming till 2026, but it's going to take a long, hard tie-up. There's also a lot to talk about in Europe as well. We do it all with Craig Trudell, who's sat here in London at the moment. And Craig, just take us over to Nissan and Honda. A deal done?
Yeah, this is going to play out over quite a while, as you alluded to. I think, real questions about, just how happy shareholders across the various companies involved are going to be with this. To put it plainly, I mean, this is really Honda coming to Nissan's rescue, and that is the writing is on the wall there in terms of looking at the terms that these companies talked about in Tokyo Monday. Honda will, take the lead in forming this holding company that Nissan will be a part of. Maybe Mitsubishi Motors will join. And the big question is, where does Renault stand in all this as Nissan's biggest shareholder? Will they be content to move forward with this style of deal?
So, Craig, how's Honda and Nissan? How are they positioning this new co? Is this going to be competitive with the Fords, the GMs, the Volkswagens of the world? Where does it want to be?
I mean, in terms of scale, it will be, one of the bigger car makers in the world. I think, if we just look at, annual sales, I mean, maybe somewhere in the third or fourth largest. But in terms of, where it's directionally heading, Nissan in particular is shrinking in dramatic fashion. Mitsubishi Motors is far and away the smallest of the three. And there's real concerns about the state of Nissan and, just to what extent Honda would want to sort of, hitch its wagon to Nissan, given the track record that it's had, really since, we're talking about, Carlos Ghosn leaving the picture in 2018. We've really seen just a steady deterioration in the state of that company. And, the product portfolio is not in good shape. There's not a whole lot of reason for optimism. And so this is, potentially a distraction within an industry that is just, extremely competitive and getting more so with the rise of Chinese companies like BYD.
And look, since 2018, there has been significant disruption around the world for autos. The rise of EVs, the rise of Tesla in the United States, the rise of them coming into China and taking Tesla's lunch there. And then you think of Europe and you think of Germany that had been, the beauty spot for all things autos. VW clearly showing that this time it's still hurting.
Yeah, and we saw that toward the end of last week, where for months now, management has been pushing for restructuring of the VW brand, which, has long clearly been an issue for the company. It's just not been competitive. It has, long had really thin profit margins. Management wanted to nip that in the bud and really, do something that is long overdue. They were not able to do that. They wanted to close as many as 3 plants. All the factories in Germany for VW will remain open, but there's yes, there's going to be some capacity reductions, but I think we've seen the shares react in a way that's, suggests a bit of a letdown in terms of what management was pushing for versus what they were actually able to extract from labor, which, as we know, they are structurally in an extremely strong negotiating position in Germany.
Craig, as we step back from 2024 and think about 2025, what's the feeling within the global auto industry about how this evolution to electric vehicles is going to take place, because I would argue that 2024 wasn't necessarily a great year. It felt like momentum in certain parts of the world, particularly here in the U.S., might have slipped a little bit. What's the feeling within the global auto industry about this transition to EVs?
I think that's a really important point that's sort of, a part of the broader landscape here, right, where it is both the case that the industry needs to move in this direction. Regulators are really, continuing to put the pressure on these companies to make that switch. And yet we have a situation where the consumer, I think, really kind of was reluctant in 2024. To your point, we saw a real slowdown in momentum for electric vehicles. Some real questions about, just how, keen car buyers are to go fully electric. In the U.S. market, hybrids have had a banner year. And I do think that that's part of what's coming into play here for Nissan. Is this is a company that, years ago, was actually in a pretty competitive position. It was out front with the Leaf. However, that car really sort of flopped, and the company has not really reinforced that bet with competitive EVs. And so I think we're seeing drastic measures to try and deal with this really uncertain environment and future for this industry.
But Craig, briefly, governments are taking drastic measures as well. Just think of the numbers from Chinese imports into Europe, absolutely curtailed at the back of these 35% tariffs by the EU.
Yeah, that's absolutely right. I think, government is likely behind this Honda-Nissan combination. We may see in Europe some softening of targets. We may see that in the UK as well in terms of CO2 emissions reductions and EV mandates. So it's definitely, I think we're in for a turbulent 2025.
All right, Craig Trudell, thank you so much. We appreciate that. Craig Trudell covers all the autos for Bloomberg News based over there in London.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.